Hey traders, going into the week of 19th of January, 2026. Last week, the VIX moved from 16.06 to 15.8, indicating a modest compression in implied volatility and a continued environment of relative calm rather than risk expansion. The U.S. 10-year yield sits at 4.227% versus 4.191% at the open of the week, pointing to slightly tighter financial conditions, though not enough to materially disrupt equity trends. TLT is above the 30-week SMA and exhibiting a positive slope. Using Weinstein's framework, bonds remain in a Stage 2 environment. As long as TLT holds above the rising 30-week SMA, the intermediate trend in bonds remains constructive. Option sentiment data shows that total put-to-call ratio reduced to 0.70 from 0.97 at the open of the week, while the equity put-to-call ratio tapered to 0.58 from 0.66. This shows investors are gradually rotating away from downside protection and leaning toward a more constructive risk stance, though not yet at levels that would signal excessive optimism. The percentage of stocks in the S&P 500 above their 50-day moving average is at 71% versus 70% at the end of last week, signaling that market participation remains strong, with most stocks still trading above their intermediate-term trend. At the same time, the percentage of stocks in the S&P 500 above their 200-day moving average is 67% versus 64%, implying strengthening long-term participation beneath the surface. Additionally, over half of the index constituents are in Stage 2 advancing phases, reinforcing that leadership is expanding beyond a small group of stocks. Key takeaway: this is a selective long week. Stay with strength, respect trend alignment, and avoid forcing shorts in a market where participation is quietly improving. This is data vesting, trading with science, not emotions.